Welcome to the Tax Sale Podcast, where tax sale investing is made easy. My name is Casey Denman. I'm a tax sale veteran, the tax sale expert, author of the Tax Sale Playbook, founder of the Tax Sale Academy, and I'm your host right here on the Tax Sale Podcast. Thank you so much for joining me on today's podcast episode. This is a completely free podcast brought to you through and because of the Tax Sale Academy. So if you are looking to learn more about investing in tax defaulted real estate, including tax liens and tax deeds, just head on over to taxsaleacademy.com. All right, today I want to discuss a few things that brand new tax sale investors tend to screw up. Now, this could be due to lack of experience, lack of education, being naive to the process, or just simply not knowing or even caring. But these are issues that I see happen frequently to brand new tax sale investors. Now, I've got 10 I want to discuss today. The first one is that they try to shortcut everything. Yes, there are shortcuts in this business, but you can't try to shortcut absolutely everything because it's just not going to work. Let me give you an example. It took me years and years to learn this business by going out there and doing it. I would make mistakes, learn from those mistakes, and keep doing it till I made fewer and fewer mistakes. Now, had I found a mentor or a training program like we offer through the Tax Sale Academy, it would have, of course, shortened that learning curve by many, many years, and it would have saved me probably well over $100,000 in mistakes made. That is an acceptable shortcut. Skipping site visits, picking random properties because you don't want to do the due diligence, ignoring research, skipping their learning process, and about 1,000 other things that I see happen on a daily basis are not acceptable shortcuts. So learn where you should and you shouldn't take shortcuts. Number 2, surface level research. I see this mistake made daily. Looking at a property assessor's report, for example, is great, but it is far from everything you need to do. You must learn how to accurately research that property. Yes, of course, that includes that property assessor's report, but it also includes things like title searches, building records, GIS, plat maps, and other resources, both through the government and through outside entities like Google and Google Maps. And something that I see frequently is that some new investors might review a few things, but they might not have any idea what they're looking at. For example, they might look at that property assessor's report, but have no idea how to actually read it and what everything on that report means to them as an investor. Just a few days ago, somebody sent me a lot that they thought was great, and it looked great on that assessor's report with surface level research. But when you dug into it, about 10 seconds into my research, it became obvious that property was a water retention area. So learn to go beyond surface level research, and you will limit your mistakes and limit your wasted money. Number 3, the next mistake that I see is new investors tend to overvalue properties. If you are a new investor, more often than not, you are going to make substantially less on a property than you originally thought you would. Many new investors will value the property that they are looking at higher than comparable properties for whatever reason. They have some sort of psychological impact when they're researching the property that says, hey, that property is worth more because of this or because of that, when in reality it is not. Never do this. Never allow your emotions to value the property for you. Instead, go on the data, go on the facts alone. You should always value your property lower than comparable properties. Yes, go on the data, go on the fact, and then round everything down. This will help add an additional buffer and removes the idea that your subject property is worth more than it actually is simply because you are thinking about buying it. So do not overvalue properties. Instead, round everything down so you shoot low with your valuations. The next one, and it's closely related, is emotional bidding. And I've told this story before about a guy that I knew that I spent about 2 or 3 minutes telling him what I did. I explained tax lien and tax deed investing in a very, very summarized fashion. To my surprise, without an ounce of any additional training, without an ounce of research, he shows up at the next auction that I go to and he starts bidding on properties. On one particular property, he kept bidding. And he kept bidding simply because he did not want to get outbid. Because he told me that. He said, I didn't want that guy to outbid me. His ego got in the way of his wallet. And I see this all the time amongst new investors. Learn how to get the correct numbers. Learn how to find those correct numbers. Learn how to stick to those numbers. And if it doesn't meet those numbers, skip it entirely. Stop with the emotional bids. Next one is they choose the wrong markets. New investors tend to flock to the biggest possible markets in their area. As such, they're usually the most populated, they attract the most attention, they have the most competition, the prices are the highest, and the margins are the lowest. Then these same investors get frustrated when properties will sell for too much money or when they don't make as much money as they thought they could. I completely understand why large markets entice them. It's easy to get information on, it's what you're familiar with, all that good stuff. And while it can work, it often does not work. Instead, my suggestion is to choose a small to mid-size market. The next one is new investors tend to have absolutely zero originality when it comes to making their investments. Listen, you don't need to go all crazy with all sorts of strange strategies or anything like that, but hear me out. If you're looking for a 1,200 square foot, 3-bedroom, 2-bathroom house on a 1/4 acre lot that needs just paint, carpet, and a new picket fence, and you're trying to get it at 50% of retail value, and that's the only thing that you want to buy, do you really think you are the only person looking for that deal? Of course you aren't. Every single person that attends an auction wants that same deal. And obviously, I could use many similar examples as well. But the point is, why should you get that deal as a brand new investor? Heck, why should anyone expect that deal? Odds are it's not going to be quite that good. So instead of going after the property that everybody else wants, adjust your strategy a little bit. Become original. If you try to do what every single other investor on earth is doing, you're going to get yourself into a race to the bottom to see who will perform the most amount of work for the cheapest amount of money possible. That is not where you want to be. The next mistake that I see a lot of brand new investors make is that they handcuff themselves to one area, which is typically going to be their home market. And I was guilty of this as well when I first got into this business. So when I started, I invested only in my home market. It's where I lived, where I grew up, where I knew everything about the real estate market there. I did very well there, but quickly I realized my income hit a ceiling. It capped. The fact is, there's only so many investments that I can make in my local market. Simply having the desire, simply wanting to invest more does not mean that deals magically will appear for you. So instead, I expanded to one county over, and then another state over, and another state, and eventually 14 or 15 more states over time. And I quickly realized that I can make much more money by cherry picking the most profitable properties throughout many different markets, throughout many different states, than I could simply by staying in one market. So if it does not work there, if you hit that income ceiling, expand your market area. Or maybe you're in a tax lien state and you want to invest in tax deeds, expand where you're willing to invest. Do not handcuff yourself to one market. The next issue that I commonly see is what I refer to as forced deadlines. So many new investors will get into this business with a goal in mind. Now, I absolutely love goals, but I love goals that make sense. The goal to buy a property within 30 days, for example, it might sound good initially, but it does not make a whole lot of sense when you really look into it. And the fact of the matter is, you don't control when the tax sale dates are. You don't control the properties that are sold, the quality of those properties, the competition that shows up to buy those properties or to bid against you, and subsequently the prices that you pay. There's literally so much here that is out of your control. It's not like losing weight. You'll just move more and eat less and you can magically lose weight, right? It's simple. You control those variables. When it comes to the tax sale business, it's not quite that easy. And having a forced deadline that I want to buy a property in this amount of time means that you'll likely back yourself into a corner. You'll make a rushed decision and you'll buy a property that you should not have purchased. So instead, maybe you set a deadline to learn the business. Maybe set a deadline to read my book, to join the academy, to watch X amount of YouTube videos, to attend an auction, to perform research, that kind of thing. Not to set a deadline that you're going to go out and buy whatever property pops up between now and next Tuesday. Instead, set a deadline that makes sense. Set a goal that makes sense. The next mistake that I see new investors make all the time is they try to act like experts in things that they are not experts in. And I mean this with all due respect, but most people are not as smart as they think they are. And that's certainly the case with me, especially when it comes to business that is not exactly what you do on a daily basis. I've seen people try to file their own suit to quiet title lawsuits, for example, to clear the title clouds off tax deed properties. Can you do it? Absolutely. You have the ability to do it in most situations if you own that property personally. Is it a bad idea? Absolutely. Hire an attorney and stay away from trying to figure out how to prepare your own lawsuits. Or maybe it's playing contractor with your remodel. Obviously, you can paint, you can maybe lay carpet yourself, put down some tile, all that good stuff. But when you start moving walls around and you're doing absolute gut jobs on these properties, you're likely going to run into issues sooner or later. And perhaps that issue is when you find the end buyer who's going to give you a lot of money for that property. They do an inspection and they realize everything that you did was done without a permit because you aren't a contractor, for example. You will eventually run into issues if you try to play experts at things that you are not truly an expert at. And the last mistake that I see made very often is when new investors are overly anxious and they dive right in without the slightest bit of training. Listen, I like people who take action. I like people who push forward. I like people who are all in. But you need to do it only after you've taken some training. You've spent the time to learn what you are doing, because otherwise it can be scary, to be honest. Let me provide a very extreme example of this that took place a few years ago from somebody who reached out to me after this took place and who, I might add, never took a single piece of training of mine prior to this. So she learned about this business. And then about a day or two later, she gets a tax sale list. She goes to that auction and she buys a house. Unbeknownst to her, that house was scheduled for demolition. So she buys this house, pays for this house. The deed is recorded in her name. A month later, that house gets knocked down by order of the city, and they paid a private company to knock it down for them. Now, the city sends her a bill about 30 days later, say, hey, you owe us quite a bit of money for this demolition expense because you were the owner of that property and because that property went into disrepair during a time in which you owned that property. Now, it does not matter that the property took 10, 15 years to deteriorate to the point where it needed to be demolished. All that mattered was when it was knocked down, when that bill was accumulated, that person owned that property. So the city, they sent her a bill. She ignored it. And what that particular city does is they sell off their bad debt to debt collection companies. And a lot of these debt collection companies are very, very aggressive. So they sent her a few demand letters, say, hey, you owe us this amount of money. She ignored that as well. Eventually, they sued her. She had a lawsuit brought against her for those demolition costs. She ignored that lawsuit as well. And the collection company that bought the debt from the city had a default judgment filed against her. And a default judgment is pretty powerful in a lot of situations. This meant the collection company had the power and did garnish her wages and her bank account. She literally woke up one morning and her bank account was empty. Now, obviously, that's a very, very extreme example. And in my 20 plus years doing this and over a decade training other people, that's the most extreme example that I have ever heard when it comes to somebody really screwing up in this business. But it does go to show you that it does happen from time to time, apparently. So what I'm trying to get at is before you dive in, before you make these rush decisions just to start buying properties, please take the time to learn what you are doing. And whether that's through formal education like we offer through the Tax Sale Academy or maybe even my book, and if you want to do that, that's fantastic. That's going to be the best way to shortcut the process. But if you don't want to do that, if you don't want to invest a dime into yourself to learn this business, at least go on Google. Watch every video you can possibly find for free about this business before you just dive in and put yourself into a horrible, horrible situation like that lady did a few years back. So there you have it. 10 ways that I commonly see brand new investors screw up. Avoid these 10 things and you'll be well ahead of most other new investors. That is all I've got for you today. If you enjoyed this podcast episode, please do us a huge favor and leave some positive feedback on whatever podcasting or video platform you're listening to us or watching us on right now. These are free episodes. I don't charge a membership or listening fee or anything like that, but your positive feedback truly helps us out in the podcasting world and might even serve to pay it forward simply because somebody checks us out because you took the time to leave a positive message or click that thumbs up button. And as always, if we can be of any additional help, be sure to check out the links in today's show notes, including the one to our step-by-step comprehensive training that we offer through the Tax Sale Academy at taxsaleacademy.com. Hey, take care, folks, and we'll see you next time right here on the Tax Sale Podcast. Bye-bye.